Today's going to be a great conversation about PACE equity and the benefits of the program itself. Can we dive in from a developer standpoint? Why would a developer want PACE equity in the capital stack? Can you kind of go over the advantages of PACE equity in the capital stack, what that means to a developer?
Yeah, absolutely. So the idea is that as you're putting your capital stack together, right now we're seeing trends that would say that, there's really two options, right? You can get a construction loan from a bank lender or a credit union, and it's going to be, a fairly low cost, but also right now a fairly low loan to cost given COVID pressures and, concerns about the economy and all the development that we've had, leading up to it. Or you can probably get a high cost, higher leverage construction loan from, say, a debt fund or, kind of non-bank institution. So what PACE equity does is we work in both of those scenarios to either do one of two things. One, in a low leverage construction loan, we can provide 10 to 25% of the capital stack, typically. I can talk about how, that sizing works later on, at a much lower cost than, say, the outside equity that you're going to have to raise to get that project done is going to cost. Typically about half the cost of equity, or say mezz, if that's your other option for funding. So it can be a really nice portion of the equity, really by providing, again, this kind of low cost, additional loan, as a part of the capital stack. Conversely, if you're working with a debt fund at a higher cost, what we can do is actually decrease their leverage and just change out dollar for dollar, what they would be loaning to you. Same thing, at about a half the cost or so. That really decreases your, weighted average cost of capital. In either scenario, what we're really doing, Bo, is funding capital at lower costs that boost returns. That's really what we're able to do through this vehicle. And one of the advantages PACE equity brings is that there's lots of compliance and structuring and integration into the capital stack. Do I have to change my design? How do I get my senior lender comfortable with this? Does it work with historic tax credits? We are experts at this. We really pioneered using this PACE tool in a capital stack in ground up construction, in redevelopments, with TIFs and very complex stacks all around the country. So we will work to give our clients we call it a fast track process. It's an all-in soup to nuts approach so that you've got the surety of what the capital looks like from a cost perspective and a sizing perspective up front.
Very good. So in the capital stack, you have your senior debt, and then you have 10 to 20%, depending on different caveats. So what was happening before, PACE was kind of mainstream, or it's starting to become mainstream now. Everybody's starting to talk about PACE. The sponsors or developers would go and they'd raise equity, or they would get some pref equity from some kind of institutional fund, which the cost of capital is a lot higher, and they would dilute their returns essentially. So from a financial standpoint, PACE in the capital stack is going to increase returns for the sponsorship team. And so that's why so many developers, not only from a financial standpoint, but also from a social impact, right? They're creating a product or a building that's not only more valuable, but it's more energy efficient and less carbon output, all the good stuff that goes along with building sustainable. So there's like multi-pronged benefits. A lot of the developers out there are always thinking, well, what's in it as far as leverage and that thing, obviously. But so there's many benefits, and that's why this business really started about 10 years ago, right, Ethan? And now over the last 2 or 3 years, it's really just kind of just booming. And last year there was probably like a little bit over $1 billion in CPACE funding. Where do you expect that to go in the next 5 or 10 years?
Well, and Bo, you're exactly right, is that we're seeing tremendous growth on a year-to-year basis in, for a couple of reasons. One, as you said, really hit it on the head, just becoming more mainstream. People are more aware that, we're out here as a solution and an alternative for them, and they're willing to explore different options, as the pressure on returns and loan to cost and cost of capital has really been, magnified, in kind of our current COVID times. So just general awareness and transactions, helps, that growth. We're also seeing new markets come online. One thing I mentioned earlier is that, so in order to do one of these projects, first there has to be state-enabled legislation. That sets up, what's eligible for funding, what the requirements are, how it works in that specific state. So that's a long process. So, if I started, a new state today, it may take 2, 3, 4, 5 years before I could actually start closing transactions in that specific state. There's 25 states, give or take today, where we can go close and fund a deal, but we've got some major markets, coming online and have come online in the past couple of years as well. So that's really just contributing to, that growth that you mentioned. Another thing that we're seeing a lot of too here at PACE Equity is what we call retroactive refinancing. In about a dozen or so states, if you've recently completed a building, major renovation, even say a PIP or something like that, we can actually pay for improvements that have been previously completed. We call that retroactive financing. So what we're seeing is that we get a lot of, developers coming to us. I just completed this work. I've got cost overruns. I have, liquidity needs to make sure I, get to the other side of COVID. And we can provide capital in that scenario as well. That's driving a lot of growth also.
And not to mention, we have a couple case studies, right, where because of the costs of timber and lumber going up, that
Exactly.
mid-construction, some developers are reaching out and some sponsors.
Exactly.
And they're kind of in a, I don't want to say a bad position, but it's a bad position when you, because their only other options to go and raise more equity, right? And so
exactly.
So we've done a new several, I'm going to call them kind of mid-construction type or construction completion, and that's before the certificate of occupancy. So you have the retroactive, which is after COE or certificate of occupancy, and then there's also the capabilities of coming in mid-construction. Can you talk about a recent mid-construction deal where you guys stepped in and kind of saved the day?
Yeah, absolutely. Well, one that comes to mind is it was a hotel that was under construction, and the flag actually changed their brand standards midway through construction. So the developers faced, a difficult choice. Do we raise more equity or go back to our, pockets and investors to do this work now, or do we simply finish the project, but then, come 24 months after completion, we're going to have to, do a renovation. It's going to cost us more money if we do it later. So we were able to come in and provide the funding for that exactly during mid-construction. Another project we were working on, as they were doing their foundation work, found that they had a lot more needs, on that side than they'd anticipated. It was about a $2 million, increase in their budget. So same thing, they hadn't even gone vertical yet, and we were able to come in and provide the financing for that rather than going back into their own pockets, save their powder for, another, new construction or development project. And that's another scenario we see too a lot, is that this additional funding, each, you kind of hit the nail on the head earlier. Each of these projects is unique. What value, what role are we playing in them? And there's, 5 different ones that come to mind. One that we're also seeing a lot of is these developers who, would really like to keep the equity, say 100% internal, or between, maybe 2 or 3 people. And we can really help them do that. That way they keep control, upside, and we're a very quiet, partner in a sense. So we're not participating in, the equity returns. We're just, getting our annual payment, and really that's it.